hoarding, we began quarterly cash surveys 7 quarters ago in mid-2010. Now that corporate cash levels are so high, corporate treasurers are changing the way they manage their cash and even their entire balance sheets. We continue to have several hundred responses to each quarter's survey, which we combine with our conversations with our corporate clients and the statistics provided by the central banks in the U.S., the Eurozone, and the U.K. First of all, we'd like to thank all of you who participated in those surveys, and we encourage you to continue in next quarter's survey, which will begin in the the fourth week of February. These responses give us the backstory of what's happening with corporate cash. They give us a look at current corporate perspectives on liquidity and on risk, and we think it's worthwhile to share all of this with you as we move in these uncharted waters. We've already conducted 2 30-minute briefings in the UK and Europe, and we will be doing our next ones in March in the US and April in the UK and Europe. So be on the lookout for our invitations. Finally, I'd like to also announce that we will be doing our 7th annual State of the Treasury Profession message on Tuesday, January 24th. And this is where Treasury Strategies at the beginning of each year opines on the challenges that we will all be facing in the upcoming year. So again, be on the lookout for those invitations. Now, today's time frame doesn't permit a live Q&A. We're trying to keep this to 30 minutes, but we do encourage you to submit questions, and we will circulate the answers to those questions. You can type questions into the question box at the bottom right corner of your screen during or after the session. And at the conclusion of the session, we ask you to spend just 1 more minute and complete a very brief exit poll, which will help us gain additional insight into the market and also help us meet your needs. Last point, we will be circulating a copy of these slides to all attendees. So you can take your notes, but we will be getting the slide deck out to you shortly. So Moni, let's get going.
Okay, thanks, Tony. Hello, everyone. So here we see on slide 2, we show the corporate cash for the UK. And as of September 30th, 2011, the Office of National Statistics here in the UK reported corporate cash at 752 billion sterling. Now, this is a tripling of cash over the last 10 years, so quite a dramatic increase. I think one thing to point out, and we pointed that out actually the last time we did this briefing, is that if there was hoarding of cash, it didn't just start with the crisis. The cash levels have been increasing fairly dramatically long before the crisis started. The other interesting thing, and we're already on the Eurozone, this is reporting of the from the Eurozone corporate cash of 1.9 trillion. And that's as of June 2011. We haven't received yet the numbers for September 2011 for the Eurozone. So the interesting thing is, and that is actually evident on this next slide, is that the cash in the UK has tripled while cash in the US and the Eurozone has doubled. So we're not quite sure what the reason is for the dramatic difference, but we have several hypotheses, and we're certainly working with our clients to come up with hypotheses and ideas around what just the reason for that.
Moni, I find it a bit curious that with the advent of the euro, right at the turn of the millennium, cash outside the Eurozone increased more rapidly than cash inside the Eurozone.
That is interesting. So that raises some other hypotheses. But so for that specific one, Tony, I think one explanation could be, and again, we'd be interested in hearing other people's thoughts, but with the introduction of the euro, it created an opportunity for much more efficient pooling of funds in Europe and in the Eurozone. And as most of you know, a lot of the pooling structures are actually headquartered in London, so we think a lot of those funds may have ended up in London. Here we're showing the next, I want to go back to just one point quickly on the last slide. We're not going to go back, but the other hypotheses for why funds are increasing so quickly in the UK, one could be, and actually really across all three regions that we're talking about, is really that we think in general, and particularly since the crisis, corporates are building up additional precautionary funds, as precaution for certainly for these uncertain times. And again, this also had to do with the Eurozone, the pooling structures I mentioned, but also with the UK as a major financial center. Again, we think that could be a key reason why there's so many more funds in the UK. Now, this next slide, which we think is actually very interesting, is that we looked at the corporate cash relative to GDP. And you can see that for a while it was moving hand in hand, but around 2002 it began to diverge. And again, we're not quite sure what this is, but it could have been changes in regulation. Again, it could have been changes in the way corporate treasurers are thinking about their cash. But
either way, Moni, it seems to indicate that there's a disengagement here, or delinking of the levels of corporate cash from the levels of activity in the real economy, which I think has some real policy considerations.
Exactly. And you can see on this slide, this is looking at for the Eurozone, and again, it's for the Eurozone, it actually started diverging earlier than it did in the UK or the US, and it's right at the time that the euro was introduced, so that could have been a factor there as well. And then you can see for the US, actually they're quite a bit closer together until recent years when they're definitely diverging.
Now, Moni, if we take a look at this from a different angle, we can see on slide 8 here, as we look at corporate cash in each region as a percentage of the gross domestic product or the economic activity in each region, we see wide disparities. For example, corporate cash in the UK in the year 2000 represented 26% of GDP, and by 2000 it's doubled. Not only is it doubled, the level of corporate cash is equal to fully 50% of total UK GDP. Clearly, the real economy doesn't need something equivalent to 50% of an annual output in the form of very short-term overnight cash. Now, in the Eurozone, that number increased from 15% of GDP to 21% over the decade, and in the U.S., 10% of GDP to 14%. So you see the Eurozone and the U.S. Both rose by about 40% over the period, while the U.K. doubled, and the Eurozone and the U.S. are a much lower fraction of total economic activity than they are in the GDP. Again, I think there are a lot of implications for corporate treasurers and particularly global companies who have a chance to move cash across these regions. Now, yet another slice of this, if we look at the total cash and total GDP across the three regions, which are well into the trillions, we find that for the total economic activity across these three regions, the UK represents 8% of the total GDP of the UK, Eurozone, and US, but 20% of the corporate cash. Again, a clear disparity here. Eurozone 41-43, that's pretty much the median there. And in the U.S., which represents 51% of the total three-region GDP, there is only 37% of the corporate cash. Each quarter, we're going to continue to take a number of views of these statistics so that we can gain insights and develop hypotheses about what's really happening here. Now, in terms of the conversations with our clients, we ask in our research and in our conversations whether companies expect to increase or decrease their levels of cash, and we're seeing fairly consistent over the last year, about 1/3 of the companies still plan on increasing their cash. So survey by survey, quarter by quarter, we're seeing more companies still forecasting an increase of cash than a decrease of cash. So we're not expecting any major change in the way companies have been managing their treasuries. We ask our clients where this cash is coming from. And this is fascinating because 90% are saying it's positive cash flow from operations. And that 90% dwarfs every other number on the page. Whether it's increase in short-term borrowings, as a source of cash, reduction of inventories, those all pale in comparison to positive cash flow from operations. What we believe at Treasury Strategies this means, and frankly what we hear from the corporate treasurers whom we deal with each day, companies have begun or are late in the stage of figuring out how to survive in this uncertain and relatively depressed economic situation. We believe that companies have now, trimmed around the edges, cut what they're going to cut, and rather than continuing to run at a high rate of speed in anticipation of a recovery, have now figured out how to generate a lot of cash whether there's a recovery or not.
Hey, so Tony?
Yes, Moni.
Hey, I think one interesting thing on this chart, back at the sources of cash, was that you saw inventories at, reduction in inventories as a source at 52% a year ago, and that's now down to, I believe, 22%. And I think this is a reflection we certainly saw with a lot of our clients, and certainly we're encouraging a lot of our clients, if they weren't already rigorously looking at their working capital as a source of internal cash, they certainly were doing it very aggressively after the crisis in 2008. So I think one of the things we're seeing is that they've already probably gotten the lion's share of what they're going to get out of that. And they're saying that while they still may see some increase in access to internal funds from inventories and other working capital, we think they've already gotten probably the largest percentage of that they're going to get.
I think you're right about that, Moni. Now, if we look at companies whose corporate cash is decreasing, we find that there's actually a pickup in capital expenditures and a pickup in acquisitions. About 41% of the UK and European companies with whom we spoke indicated an uptick in capital expenditures. 27% said acquisitions, and interestingly, 24% are beginning to return some money to the shareholders in terms of dividends or special dividends. Only a quarter, or only 22%, indicated that the negative cash flow from operations is eating into their cash levels. I think there's a lot of good news in this slide, although frankly I must say that once you defer capital expenditures, 1 year, 2 years, 3 years, and now 4 years, at some point you have to put some money into your building just to be able to turn on the lights. So we're not sure, I think it's too early to call this a bullish signal, but we do see encouragement here. Now, if we look at how our corporate clients are managing their interest rate risk, and frankly, all of their risks, we have some interesting findings here. And the key takeaway from this part of our research is that we believe most companies are pretty satisfied with what they've already done in terms of managing their maturity structure, their credit risk, and their foreign currency exposures. Now, to break that down just a little bit, you can see on page 14, when we ask about maturity structures and whether companies expect to lengthen them or shorten them, we're evenly split, 15%, 13%. Most significantly, though, 72% expect them to stay about the same, which leads us to believe that companies have made their adjustments there. Now, if you are in that 28% that's not about the same, then it may be very important for you to start taking or to take a closer look, and of course we at Treasury Strategies would love to help you do that. Now, in terms of credit risk, we're seeing the same outcome. About 3/4 of the companies plan on managing their credit risk in about the same manner as they're currently managing. Only 14% said they would expect to become more conservative over the next 6 months, and 10% said less conservative. Now, on the next page, we look at the same breakout in terms of foreign exchange exposures, and again, 2/3 plan on keeping things about the same. Now, the split between the remaining 1/3 between the increasing and decreasing, curiously enough, shows a bias on the increasing side. So by and large, what we're learning from here in terms of risk management is that most of our clients feel that they've already made the appropriate adjustments, but somewhere between 1/4 and 1/3 still have work to do here. And again, we would encourage you to get about the business of doing that. We ask our clients what their actual maturity structure is, and frankly, we're just swept away by the fact that about 3/4 of all liquidity is in a form that can be accessed in an overnight manner, with either overnight government securities or bank deposits or money market funds, things that provide same-day or next-day liquidity. There's no other maturity bucket that goes that's anywhere near that, and in fact, if you were to look at the cumulative effect, 95% of all liquidity is at 1 year or less. This tells us that in spite of the very low and flat yield curve going out to the 2 or 3 year mark, most corporate treasurers have decided not to reach for yield by extending their maturities. We hear a lot of conversation among treasurers about doing that or about moving to actively managed portfolios to grab additional yield, but frankly, in our sense, that appears to be conversation and not action. Page 17 takes another look at this, and it shows that half of all the European and UK liquidity is held in current accounts and another 1/6 in term deposits. So 2/3 of the liquidity is held in the banking system. Now, we think there's an interesting policy dimension to that, given regulatory changes that the banks are now experiencing. And it may be appropriate for corporate treasurers to step back and understand how these banking regulations could pass through and affect them, because 2/3 of your deposits or 2/3 of your liquidity is with the banks. I will point out that this is a different profile than what we see elsewhere in the world, and particularly in the U.S., we do not see bank deposits at the 68% range. Now, I mentioned that we have conversations with our clients regularly, and on page 18, we list what some of our clients are telling us. And Moni, you're talking to our clients every day. Why don't you tell us what you're hearing?
Yeah, well, this what we're showing on 18, I think, is verbatim from the survey, but it reflects what we're hearing from our clients. And some of it we've mentioned, but in the upper right hand, that they're building up liquidity as a buffer. They say for when the banks increase short-term borrowing, or if you look right in the middle at the top, it's a strategic reserve against possible default risk with their groups, bank facilities. Now, on the left, one of the things we're seeing, particularly among the largest multinationals, is they've got a lot of cash and they're not quite sure what to do with it. So looking for the suitable investments, and I'm sure when they go to certain banks, banks only want so much in deposits. So they're looking for where to place that. It was interesting. I was meeting yesterday with Peter Matza from the UK Association of Corporate Treasurers, and in talking with some of their members, and again with some of the largest multinationals, one of their biggest concerns is how much cash they have, and concerned about what to do with it, and also concerned about, they thought that would probably be short term when they started building the cash reserves, but it's lasting longer and longer. So what are the implications for their balance sheet and for their capital structure? So again, I think all these represent what we've been seeing in the market.
Well, and not only is this of interest to corporate treasurers and financial institutions and associations like the ACT and other Treasury groups across Europe that you see. A couple weeks ago, Moni, as you know, I was invited to have dinner with the British Consul General, and the entire topic of the conversation was how companies are moving their cash, and in particular what the impact of that cash movement is on global cash flows. So, you know, even at relatively high political and public sector levels, corporate cash and the attitudes of corporate treasurers is a major concern.
Right. Now, on this slide, we asked the participants what their plans were, what changes they were looking for, and with their corporate cash. And this is reflective of what we see, what we recommend, and I think particularly since the crisis, certainly an increasing reliance on cash forecasting. And I would think there's a lot more cash forecasting going on right now, as particularly well, globally, but particularly in the Eurozone and UK, as companies anticipate what the impact would be if the Eurozone broke up. So again, forecasting is critical for understanding, you know, what the potential scenarios might be and what your access to liquidity would be in those scenarios.
Moni, you know, it looks like across the board companies are digging in for the long term here. They're building infrastructure to manage larger cash pools. They are modifying their policies in order to make sure they're buttoned up in terms of managing larger and longer term cash pools. You know, as I read this, and you know, we at Treasury Strategies feel that this is kind of digging in for the long term.
And I think it's also reflective of the fact that what we see as Treasury really having become the nerve center of the organization. When there's a crisis, the executive management, the board, the business units, everyone, the outside investors, the rating agencies are all looking to Treasury to assess the impact to the company, look at the counterparty risk, look at all the scenarios. So we believe Treasury is really having to put in place, Tony, as you mentioned, the infrastructure that enables them to effectively perform their role as that critical nerve center.
Now, as most of you on the line know, Treasury Strategies has pioneered the concept of Treasury 3.0, with the next generation of Treasury management, which Moni in shorthand referred to as Treasury becoming the financial nerve center. We have extensive writings about this on our website that you can access, and we also have a LinkedIn group called Treasury 3.0, which is having some really robust conversations about the increase particularly in technology within corporate treasury. So, you know, we would invite you to join and contribute to that conversation. Now, no conversation about corporate cash in the UK and the Eurozone would be complete without a discussion of the current turmoil and the euro. And we are having very explicit conversations with a number of our clients about this. And we use the term redenomination risk to describe what it is we believe corporate treasurers need to assess. And while the possibility of a breakup of the euro is, you know, a low probability outcome, the impact of such an event is significant. So when you look at the cross product of the two, low probability times truly significant impact, it rises to the level of materiality. And we believe that corporate treasurers now have a fiduciary responsibility in their role in order, you know, to evaluate the impact of various scenarios on the firm. And when we work with our clients, we're actually looking at three different scenarios. The scenario of a single country exit, a multi-country exit, and a total breakup of the Eurozone. Obviously, in a briefing, we're not going to go into detail on that, but we would be happy to have conversations with you about that. Now, further complicating this is a number of uncertainties. For example, if there were a breakup, what would be the denomination of existing obligations. And while it might be very easy to say, well, you know, if something's currently denominated in X, it will continue to be denominated in X. If I have to pay my bonds in euro, I will still have to in the future. But we must say that is not entirely clear, and if there were disputes around that, it is certainly not clear where the jurisdiction in adjudicating those disputes would reside, and clearly depending on the jurisdiction, that could have a high bearing on the outcome. And then there's the global concept of sovereign immunity, and can the Prime Minister of country X simply declare that particular country's obligations will be completely redenominated? And obviously these are question marks. There are a lot of impacts here. And we believe that, again, the cross product of the low probability times the very high severity of the outcome rises to a level of materiality, and it has now become a fiduciary obligation of corporate treasurers to assess the multiple scenarios. So, Moni, would you like to put a bow on this?
Sure, I'd like to put a bow on it. So we thought we'd share with you some of the key themes that are emerging from the consulting work we're doing with our clients. Now keep in mind that each client's very individual, so what we're recommending and what we're working together with them on can be very different depending on the individual situations. But I think this by and large really represents some of the key things that are the themes that are coming out of the work that we do. So review and clarify investment policies. Very clearly something that everyone needs to do, and probably much more frequently than they used to do it. Keeping maturities short, which clearly everyone is doing. Increasing credit quality to ensure access to credit. Moving assets into money market funds as a cash equivalent. Issuing commercial paper as much as the market will absorb. Issuing debt securities, again, as much as the market will absorb. And the last two really around infrastructure, improving Treasury technology tools and the ability to provide analytics internally, and improving cash forecasting.
So it's a very tricky time and a lot of moving parts here. And again, because every company is unique and operates in multiple jurisdictions and under multiple regulatory regimes, there is no one-size-fits-all answer, as Moni pointed out. A real quick thumbnail description of some of the things that we're doing for our clients regarding assessing Eurozone breakups. Number one, we're helping our clients assess all the primary and the secondary Eurozone exposures. While a primary impact is something that touches you directly, a secondary impact is something that impacts your customers, your suppliers, or your financial institutions. So even if you have no direct Eurozone exposure, you probably have secondary Eurozone exposure. We want to stress test these exposures under the three scenarios that we talked about. Number three, extremely important. We think now is the time to clarify any uncertainty in your contracts about what the payment terms would look like should there be a currency redenomination. Number four, reach into your organization, implement as many natural hedges as feasible, and in the conversations we're having with our clients, everyone is kind of surprised at the opportunity here. And then finally, structure financial hedges, although there still aren't, as far as we know, futures on new currencies yet being traded. There are ways to construct a financial hedge.
So as we wrap up, we're going to show you an exit poll shortly that we would like you to complete before you sign off. And we would like to thank you for joining us. Here's a bit about Treasury Strategies. We're the leading Treasury consultancy working with corporates and financial services providers across Treasury, working capital management, liquidity, and payments. And we'd love to be working with you. If you have any questions, please feel free to contact Tony or myself, and here's our contact details. And again, you will be getting a copy of this of the presentation with our contact details in that shortly. So thank you very much. Also, one more thing, please feel free to join one of our many Treasury and Finance groups on LinkedIn. Lots of good conversations going on there. And thank you for joining us.